Howdy, everybody. Welcome to Liberty Call. Today is Friday, December 13th, 2024. Hope you're having a fantastical day out there in the interwebs. It's a little nicer here in Colorado today. It's not as overcast this afternoon, which is nice. Lets the sun come out, warm the house up, which is wonderful. And we got some turkeys wandering around in my front yard right now. I'm not sure what they're eating because there's nothing but snow out there. So I see them kicking around trying to find the dirt. So anyways, well, before we jump into the numbers, if you could do me a favor, if you could give me some thumbs up, a like, share, subscribe, a follow, and press that notification bell. All righty, well, let's hop into today's markets. Dow Jones was down 0.2%, 86 points. Closed at 43,828. S&P 500 flat, down 0.02, 1 point. Closed at 6050. NASDAQ up 0.11%, 21 points. Closed at 19,924. The VIX was down 0.79% today. It's at 1381. Canada down 0.54. Brazil down 1.16%. And Mexico up 0.72. In Europe, Germany was down 0.17, the UK down 0.14, France down 0.15, the Netherlands down 0.1%, Spain down 0.11, Italy up 0.09, Switzerland down 0.29, and Portugal down 0.11. Russian exchange is mixed today. The MOEX down 0.32, the RTSI up 0.18. And the overnight markets, the Nikkei in Japan was down 1.02%, Australia down 0.41, New Zealand down 0.07. In China, the Shanghai was down 2.01, Shenzhen Component down 2.23%, China A50 down 2.47%, DJ Shanghai down 2.11%, Hang Seng down 2.09, and the Taiwan weighted down 0.11. All right, so those are our markets. Let's bring up the charts and take a look and see how we did for the week. Let's see here. Looks like it's going to be down. Starting out with the Dow. The Dow Jones is going to be down 1.76% for the week. The where is it? Let me start right there. The S&P 500 is going to finish the week down about 0.62. The NASDAQ looks like it's going to finish barely in the green, up 0.3. The Dow Transports finish in the red by 0.95, and the Dow Utilities will be in the red 3.13%. So big, for the major indexes, kind of muted, nothing too dramatic. Let's zoom out and take a look at the markets as a whole. Put my trend lines back on here. So we can see here in this late run-up we had since August on the Dow, we broke the resistance line here in late October. And then after the election, we've had kind of some volatility where it's been bouncing off that same trend line and has been trending down since the 5th. So more than a week, the Dow have we had any green? Nope, nothing but red. So, and if we go over to the S&P chart, sort of similar, but flat in the last week. And then the NASDAQ, while it did, has been kind of squirreling around this trend line, still is continuing an upward trend. So what that kind of tells us is that, your high-tech growth stocks are still in an upward trend. Your blue chips, on the other hand, are losing some strength. So, and then the broad market is just kind of flat. So, all right. So that's your charting lesson for the week. Do you feel smarter out there? All righty. Well, let's get to the economic numbers or data that came out this week, starting out with jobs. Initial jobless claims came in at 242,000. Forecast was 221. Previous number was 225. Continuing claims came in at 1.886 million. Forecast was 1.880. Previous number was 1.871, so a slight tick up. Non-farm productivity quarter over quarter grew at 2.2%, right on forecast. Previous number was 2.5%. Unit labor costs increased by 0.8%. Forecast was 1.8. Previous number was 0.4. The consumer price index year over year, you probably saw the numbers in the news this week, grew by 2.7%. Forecast was right on forecast, 2.7. Previous number was 2.6. And on month, it grew by 0.3%, right on forecast. Previous number was 0.2. The producer prices index grew at 3%. Forecast was 2.6. Previous number was 2.6. And month over month, it grew by 0.4. Forecast was 0.2. Previous number was a 0.3. And import and export prices, starting out with import prices grew by 1.3% annually. Previous number was a 0.6. And export prices grew by 0.8. Previous number was a contraction of 0.1. All right, so that's all the economic data for the week. It's not terrible, but again, not great. I'm curious to see what the most recent consumer spending numbers are going to be, see if they continue to trend in that northeastern, well, as you're looking at a chart going this way, heading in that northeastern direction on the XY axes. But, when it flattens out, to me, that'll be the pretty much a fairly clear indicator that the economy is really starting to slow. And then we could really expect to start to see the jobs numbers deteriorate and so on. But until spending really slows, I just don't see that happening. Again, some weird things can happen, but, that's kind of my expectation at the moment. All right, let's get to the market recap. S&P 500 slips to remain on track for weekly loss ahead of Fed meeting next week. The S&P 500 edged lower on Friday, heading for a weekly loss as investors maintain caution ahead of next week's Federal Reserve meeting. Market uncertainty heightened following Thursday's stronger than expected producer price index inflation data, which raised concerns about the long-term trajectory of interest rates. All right, moving on. Broadcom Inc. shares surged 20% after the chipmaker provided an optimistic revenue forecast for the current quarter, driven by increasing demand for artificial intelligence chips. Despite missing revenue expectations, upbeat commentary from executives reignited investor enthusiasm for AI-related growth. Tesla rose over 2% amid reports that President-elect Donald Trump might eliminate a program requiring companies to report automated vehicle crash data. This change could benefit Tesla, which has filed over 1,500 reports under the program. RH, formerly Restoration Hardware, gained 14% after the home furnishings company raised its outlook for the fourth quarter and full year, citing accelerating demand growth. Meanwhile, EVgo climbed 2.7% after finalizing a $1.25 billion loan from the Department of Energy to expand its fast charging network. So they borrowed it from us, folks. Awesome. And finishing up, while the economic calendar was light on Friday, the market remains fixated on next week's Federal Reserve meeting. The central bank is expected to cut rates by 25 basis points, with trader bets exceeding 96%. However, recent sticky inflation data has fueled fears of a slower pace of rate cuts in 2025. Investors anticipate the Fed's decisions and guidance to significantly impact market sentiment in the weeks ahead. Again, I'm not sure what, we've already cut rates 0.75%. They expect another 0.25% rate cut next week, which would bring us from where we were at between 5.25 and 5.5 down to 4.25 and 4.5. What does that really do for anything? That's the $1 million question that I would ask folks is, what difference does that make? Yes, zero interest rates are significant, but 4 to 6, is that really huge? Again, I'm not a lender, so I'm not running amortization tables and things like that all the time. So, and I'm not in the, I'm not borrowing money to make my operations go. So it's, anyways. All righty, next up from Zero Hedge, Goldman delivers a grim outlook for prospective homebuyers. So if you're in the home buying market, things are still tough. Goldman Sachs predicts that the housing affordability crisis will persist through 2025 as high mortgage rates and record housing prices continue to challenge prospective buyers. In a recent note, analysts Susan McClary and Charles Perron-Piche forecast that the 30-year fixed mortgage rate will remain in the low to mid 6% range next year, ending 2025 at around 6.3%. This represents only a modest decline from the 6.6% rate anticipated at the close of this year, even as the Federal Reserve is expected to cut rates by 125 basis points through September of 2025. So is that 125 from now or 125 for the peak? Because that means we only got 50 basis points more to work with. So the forecast, coupled with November's mixed inflation data and inline CPI report, but stronger than expected PPI print, indicates that longer-term yields are likely to remain elevated. squashing hopes for significant relief in mortgage rates. As a result, existing home sales are projected to remain 25% below their 2015 to 2019 average, with transactions hovering around 4.1 million compared to the pre-pandemic average of 5.4 million. Goldman also expects home prices to rise by about 3% year over year in 2025, driven by limited inventory and the lock-in effect, or homeowners with lower mortgages are reluctant to move. The average mortgage payment for a median-priced home is estimated to consume about 35% of median household income, well above the 30% threshold most lenders consider manageable. The report paints a grim picture for buyers, emphasizing that affordability challenges are unlikely to ease soon. Even if mortgage rates decline slightly, prospective buyers in the housing market face a prolonged period of stagnation and elevated costs. Well, here would be my suggestion, just for anyone out there who's, trying to get their first house, underbuy. If you're buying a pre-existing home, find one in a nice neighborhood that is probably the worst house in the neighborhood, buy it and fix it up. You're going to get way more bang for your buck doing that than buying the most expensive house in a neighborhood, because it just doesn't have a lot of room to grow. So, and if you're buying a new home, again, underbuy. You could always move up later on in life if, incomes and things like that improve, and your skills allow you to improve your employment perspectives. But that's my suggestion. I mean, it's worked out well for us we bought 2 new homes, and then since then we've been in pre-existing homes. Used doesn't sound right. So, but anyways, we certainly did better on the pre-existing homes than we did on the new stuff, because you got in a new home you got to live there for a while before you actually make any profits. So, alrighty. Last up, also from Zero Hedge, the big shining lie: we're better off now. So this was written by Charles Hugh Smith via of2minds.com blog. So let's see what he had to say. In an analysis of economic trends over the past 4 decades, Charles Hugh Smith argues that the average American is significantly poorer today than in the past, despite widespread claims to the contrary. He critiques the narrative promoted by economists and media that prosperity has improved, attributing these claims to manipulated statistics and propaganda. The core issue Smith contains is the collapse of the purchasing power, the true measure of prosperity, defined as how much an hour of labor can buy in essential things like housing, healthcare, and transportation. So key points: purchasing power declined. In the 1970s and 80s, basic needs required fewer hours worked. For example, Smith paid his monthly rent in Honolulu with 3 days' wages in 1977. Today, it would necessitate an hourly wage of $60 to $90 an hour, far exceeding median incomes. Similarly, healthcare premiums, utilities, and auto repairs were once manageable with just a few hours of work, but these costs now consume a much larger portion of income. Rising costs and decreasing quality. Housing costs have surged. In the 1980s, Smith built homes for a fraction of today's costs. Materials and appliances were more durable, while today's options are expensive and less reliable. Vehicles, too, have become more costly and difficult to repair, undermining their value despite added features like advanced electronics. And going back to the home goods thing, I mentioned it was either earlier this week or last week. The refrigerator in my dad's house has been there since the early 80s. Unless he's changed it out since the last time I was there. I think I was at his house in March, so it was there then. But those things lasted forever. We replaced our washing machine, I think it was last year, and we had that thing since the 97 or 8, somewhere around there. The thing just. The only thing that really crapped out was the electronics, the wiring, and all that stuff that ran the timers and things like that. As far as the unit itself, the drum and everything was still great. Probably needed some new belts and stuff, but granted, the one we have now is much fancier. It's got all these cool bells and whistles. It's a front loader, but my fear is that it's going to croak in 10 years, and we'll wind up spending more money. So, anyways, same thing with cars. Cars you can rebuild, and they're very easy to work on. Today, not so much. All right, next section, economic imbalance. Wages as a share of GDP have dropped from 51.6% in 1975 to 43% today, meaning workers have a smaller portion of economic output. Inflation-adjusted incomes have not kept pace with soaring costs of essentials, leaving little room for savings or discretionary spending. Savings and disposable income. In the 1970s, saving 40 to 50% of net pay was achievable with modest frugality. Today, this level of savings is rare without external support, subsidies, or elite earnings. Smith concludes that ignoring the reality of this decline impedes meaningful reform, warning that wishful thinking will not fix economic challenges facing Americans today. Recognizing the erosion of real prosperity is essential in addressing systemic issues. Yeah, I mean, I just look in, the time I've been in this field of work, let's see if my chart goes back that far. Gold, how far does gold go back? No, it doesn't go back to 2011, but, I think the price of gold was, $300-400 an ounce back when I started this business in the mid 2000s. So, what I used to charge for, what I would, if you were to compare, what I would charge for financial planning services, just developing a plan and, presenting it to the client and implementation over the first year, that'd be anywhere, $300 to $1,000 for a client, and which would relate to 1 to 2 ounces of gold, at the time. Well, if I was still charging an ounces of gold, gold is what, 20, what's it at today? 26.49. So, financial planning fees would range anywhere from, say, $2,600 to $5,200. Again, we've lost our buying power, and that's really what that article is trying to point out. So, anyways, all right. Well, that's everything that I had to cover for today. If anyone needs anything from me, please go to DSAFinancialGroup.com. All your financial planning needs can be addressed there. So give me a buzz. I'd be happy to help get you on track, because whether or not it's budgeting, planning for retirement, how to invest, making sure you're protected for the what ifs can happen in life, give me a call. I'd be happy to help. All right. Well, like I said, that's everything that I had for today. And if anyone needs anything from me, go to the website. Otherwise, have a fantastical weekend. And I'll talk to everyone next time. Adios.